Imagine standing on a battlefield where survival is rare, the air thick with smoke and fear. 9 of every 10 soldiers never return, their ambitions buried under dust and silence. That is trading. The market is not a calm classroom or a tidy boardroom. It is a war zone where every candle is a volley of arrows, every wick a bullet grazing someone's helmet. The shocking truth is simple. 90% of traders lose, and those who charge forward blindly become statistics written in red. Yet within this chaos, there are survivors, warriors who move with patience and clarity. They don't waste ammunition firing at shadows. They wait, observe, and strike with precision. The question isn't whether the field is dangerous, but whether you step onto it as a rookie chasing adrenaline or as a commander crafting a campaign. The war never stops. The market opens tomorrow, and the next battle awaits you. Many traders believe the secret to success is constant movement, as if the market rewards the busiest soldier on the field. They fire order after order, thinking sheer activity will deliver profits. But the battlefield tells a harsher story. The one who sprays bullets at every shadow doesn't win. He empties his weapon long before the real enemy appears. In trading, this mistake drains your account just as surely as a reckless charge drains an army's strength. Professionals understand that survival is not about doing more, but about waiting longer. They know that silence can be power, that the pause before action is often where victory is born. The amateurs rush out and fall. The disciplines stay behind cover, watching, planning, until the moment comes to strike. The trap of constant action is seductive, but the truth is simple. Patience saves more capital than any strategy, and restraint is the sharpest weapon you carry. Freedom in trading doesn't come from chasing every candle or piling up indicators. It comes from mastery, from learning to think like a general rather than a foot soldier. The rookie charges headlong, chasing adrenaline and mistaking noise for opportunity. But the commander pauses, studies the terrain, and sees the patterns that others miss. Mastery is not about knowing everything. It is about stripping away distractions until the battlefield becomes clear. When you stop reacting to every flicker and start choosing battles with intention, the market shifts from being a monster that devours you into a weapon you can wield. This is the difference between exhaustion and empowerment. A soldier spends energy fighting blindly, but a general conserves it, striking only when the moment guarantees advantage. Freedom is not found in chaos. It is discovered in clarity, in discipline, and in the steady confidence of a warrior who knows exactly when to act. When I first began trading, I thought the secret was hidden in complexity. My screens looked like Christmas trees, lit with every indicator I could find: RSI, MACD, Bollinger Bands, Ichimoku clouds layered in wild colors. Each one promised certainty, yet together they delivered only confusion. One indicator shouted buy, while another screamed sell, and in the middle of the noise, my account bled. I wasn't trading the market anymore. I was trading my indicators, staring at maps while ignoring the ambush right in front of me. Complexity is seductive because it feels safe, like building armor out of numbers. But on the battlefield, complexity kills. When bullets are flying, you don't need 10 scouts shouting different reports. You need one clear signal. That clarity comes from price itself. A single candle closing strong tells more truth than a dozen oscillators. A clean breakout, a decisive range break, carries more weight than layers of moving averages. Simplicity sharpens your vision. It teaches you to strip away clutter until the market reveals its true terrain. With a clear chart, your patience grows. You stop searching for reasons to trade and instead wait for permission. The irony is that rookies fear simplicity. They think it makes them unprepared, but the pros know the opposite is true. A commander with a clean map can act with confidence, while a rookie drowns in clutter. Simplicity doesn't mean ignorance. It means precision, focus, and discipline. It gives you the courage to say, not yet, the wisdom to skip the ambush, and the strength to fire only when the moment is undeniable. Every battlefield has terrain, and the market is no different. Step onto the field without understanding the ground beneath your feet, and you are already lost. There are 4 terrains every trader must learn to recognize because each demands a different strategy. The first is the advancing front, the uptrend. Picture an army pressing forward, capturing hill after hill, each new high a signal that buyers hold control. In this terrain, Long trades flourish because momentum is already carrying you forward. The second is the retreating collapse, the downtrend. Here, sellers dominate, pushing price lower with relentless pressure. Each new low is a fortress falling, and short trades thrive when you align with this tide. The third terrain is the stable trench, the sideways market with structure. Imagine two armies dug in, facing one another across a no man's land. Price bounces between support and resistance, predictable and contained. A disciplined trader can exploit this range, buying low, selling high, using the walls for cover. But the fourth terrain is the most dangerous, the chaotic minefield, sideways with no rules. Here, support and resistance fail without warning. Price whipsaws in every direction, and traders are shredded by false signals. Stop losses explode like landmines, wiping out the unprepared. The lesson is clear: survival depends on terrain recognition. Too many rookies charge into chaos thinking every field is the same. They attack when they should retreat, defend when they should press forward. Professionals adapt. They read the ground first, then choose tactics. In trading, as in war, knowing where you stand is the first step to survival. Out on the battlefield, no ground is deadlier than the ambush zone. At first glance, it looks harmless, an open field under calm skies, but hidden beneath the soil are mines, and in the shadows, archers lie in wait. That is exactly what chaotic sideways markets are, traps disguised as opportunity. Price teases you with a gentle climb, luring breakout buyers, then slams down and wipes them out. Moments later, it dips beneath support, baiting shorts, only to reverse upward with equal brutality. What looks like order is only deception. In 2024, the S&P drifted in such a range for weeks, a narrow band that tempted traders with promises of trends. One day headlines called for new highs, the next for collapse, and each side was slaughtered in turn. Chaotic sideways is not the same as a stable trench. In the trench, walls are respected and rules apply. In chaos, every wall crumbles. Every rule is broken. It is like fighting in a fog where enemies strike from nowhere. The harsh truth is this: even professionals know better than to fight in ambush zones. They step aside, preserving capital and clarity. Rookies, by contrast, believe they must fight every day, and this belief becomes their undoing. Think of your worst losses. Were they in clean trends or in choppy indecision? Most scars are born in the chop. The market rewards patience, not recklessness. Avoiding the ambush is as profitable as winning a clean battle because every bullet saved is strength preserved for when the real opportunity comes. Every battlefield has its cautionary tale. The story survivors whisper about what happens when discipline slips. In 2024, Tesla gave traders one of the clearest examples. The stock approached the $400 level, a fortress wall watched by the entire market. Social media buzzed, headlines roared, and retail traders crowded at the gates. Then, seemingly in triumph, Tesla broke through. The breakout looked glorious. The crowd rushed in, convinced they were witnessing history. But there was no confirmation, no decisive candle, no surge of momentum. Instead, hesitation filled the air, and then the market turned with brutal speed. Price reversed hard, collapsing back beneath the level. Those who bought the breakout found themselves trapped in the open field. Stop losses lined up like soldiers in formation, cut down one by one. What seemed like victory was a well-laid ambush. This was no random move. It was a liquidity hunt. Larger players knew exactly where retail orders sat. They pushed price just far enough to trigger excitement, then reversed, using those exits as fuel. For rookies, the loss was devastating, not just financially, but emotionally. Betrayal, shame, and doubt settled in their minds, leaving scars that bled into future trades. Yet for the disciplined, Tesla's move was a lesson and an opportunity. Those who recognized the missing signal stayed out or even shorted the reversal, joining the counterattack once the trap was sprung. The story of Tesla at $400 proved a timeless truth. Markets don't reward belief, they reward evidence. Without confirmation, every breakout is just bait. If Tesla's fake breakout was a warning, Bitcoin's pullback in November 2024 was the counterpoint, a masterclass in how patience turns chaos into clarity. The world had just watched Bitcoin storm through $120,000, a fortress wall that seemed unbreakable. Headlines screamed, social media roared, and rookies piled in at the top, desperate not to miss the victory parade. But generals don't chase glory. They wait for the regroup. And soon, Price pulled back into the 115,000 to 118,000 zone. To the untrained eye, it looked terrifying, as if collapse was imminent. Panic spread, voices that once shouted new highs now whispered doom. But disciplined traders saw balance, not danger. They read the pullback as a return to fortress ground, aligned with key levels, not as random retreat. Then came the signal. First, weakness in sellers, long wicks showing failed pushes down. Next, the standoff, a tight cluster of candles marking hesitation. Finally, the breakthrough, a decisive green candle roaring above the zone. That was the moment to strike. Traders who entered there weren't gambling, they were aligning with evidence, joining the strong side after confirmation. The result was one of the cleanest long entries of the year, a victory built not on impulse, but on patience. Meanwhile, those who chased the breakout at $124,000 bled capital and confidence. The lesson was seared into the charts. Discipline turns fear into opportunity. The rookies saw collapse, but the generals saw balance, and those who waited reaped the reward. Every army needs strongholds, and in an uptrend, buyers build fortresses to anchor their advance. These fortresses are not random spots on a chart, but battlefields where momentum first shifted. The first fortress is the wave's origin, the point where sellers once held control until buyers surged with overwhelming force. That turning point carries memory, and when price later pulls back, buyers often defend it fiercely, eager to preserve the ground they first captured. The second fortress is the broken high. Imagine a wall that held for weeks, maybe months, until buyers finally smash through with conviction. That breach is proof of strength, and when price returns to retest it, the old resistance often becomes new support. Together, these two fortresses form the backbone of any buyer's campaign. Look at Bitcoin's breakout above $120,000 in late 2024. That old high became a fortress, and when price pulled back into the 115 to 118,000 zone, buyers defended it with precision. The rookies saw panic. The generals saw opportunity. Trading from fortresses is not about prediction, but probability. In a fortress, you fight with walls at your back, structure to define risk, and allies ready to defend. Outside of them, you fight in open fields where danger strikes from every direction. The disciplined trader waits for price to return to these bastions, watching carefully to see if defenders hold the line or if enemies regroup. Either way, the fortress provides clarity, turning random noise into defined battlegrounds where risk is limited and reward magnified. If uptrends are stories of advancing armies, downtrends are tales of retreat and domination by the enemy. Sellers also build fortresses, and learning to recognize them can mean the difference between profit and ruin. The first seller fortress forms when price rallies into supply after a sharp decline. Imagine a beaten army trying to regroup, pushing forward for a counterattack. They advance a little, but the dominant side is already waiting, entrenched with cannons loaded. That rally into supply is not strength, it is weakness exposed. Sellers strike back, overwhelming buyers who dared step into enemy fire. The second fortress is the broken low. Think of it as a wall buyers defended again and again until finally it crumbled. Once breached, that ground belongs to the bears. When price rallies to retest the broken low, it often becomes a seller stronghold. Buyers try to reclaim it, but sellers, empowered by momentum, slam the door shut. This pattern played out in 2024 with stocks like Nvidia. After a huge AI-driven rally, exhaustion set in. As the price pulled back into supply zones around $420, sellers surged to defend. Each attempt by dip buyers was crushed, and broken supports flipped into resistance. Those who recognized these bearish bastions aligned with the stronger side, riding the downtrend instead of fighting uphill. The lesson is clear: in downtrends, humility is survival. You don't charge fortified positions head-on. You wait for price to march into seller fortresses, then join the defense. In this way, even decline becomes opportunity. Every fortress looks unbreakable until the day it falls. In trading, this collapse is sudden, brutal, and often emotional. A level that once held strong crumbles under relentless pressure, leaving those inside shocked and exposed. There are two main ways these collapses unfold. The first is the false breakout. Price edges just beyond a key level, slipping above resistance or below support enough to fool the eager crowd. Traders rush in, believing victory is theirs, only to watch momentum stall and reverse violently. What seemed like triumph becomes a trap, and the fortress they thought captured was nothing but bait. Tesla's fake move at $400 was exactly this, a false breach that slaughtered the impatient. The second collapse is overextension. Here, price surges far beyond a level with explosive strength, carrying traders deep into enemy ground. At first, it feels unstoppable, but supply lines snap, momentum fades, and a vicious reversal cuts down everyone who chased too far. Bitcoin's December 2024 run to $124,000 was the perfect example. His traders cheered as it smashed through resistance, yet weeks later it plunged back to $111,000, erasing billions. The emotional damage was as severe as the financial loss. The truth is, no fortress is invincible. Treating levels as sacred blinds you to reality. Survival demands humility and vigilance. By watching for heavy wicks, stalling candles, or exhausted momentum, you can see the cracks forming. Collapse creates opportunity, but only for those patient enough to wait for the dust to settle. While rookies are buried in the ruins, the disciplined step in and seize the ground left behind. On every battlefield, generals carry a compass, not because they don't know where they are, but because they must measure distance, how far the army has advanced, how far it must retreat, and where balance lies. In trading, that compass is Fibonacci. It doesn't predict the future or magically control price, but it measures proportion, and proportion is the difference between a move that holds and one that collapses. After a strong advance, price almost always pulls back. But how deep is healthy? Too shallow and buyers haven't regrouped. Too deep and the defense is broken. Fibonacci retracements, especially the 0.5 and 0.618 levels, reveal the sweet spot, the ground where balance is restored. Think of Bitcoin's surge past $120,000 in November 2024. When it pulled back into 115,000, that zone aligned almost perfectly with the 50 to 61.8% retracement. It wasn't coincidence, it was structure. Buyers stepped in, defending not just a fortress, but equilibrium itself. This is why disciplined traders love Fibonacci, not as superstition, but as a tool for measuring balance. A soldier sprinting 20 feet still has strength. One sprinting 200 collapses from exhaustion. Fibonacci tells you which is which. But here's the trap. Rookies slap Fibonacci on every chart, every time frame, like a magic wand. Used alone, it is nothing but numbers. Its power comes when it aligns with real terrain, fortresses, wave origins, broken highs or lows. When multiple forces converge, probability stacks in your favor. Alone, the compass is just direction. Aligned, it becomes strategy. That is the true gift of Fibonacci: clarity, balance, and measured confidence in the chaos of war. On the battlefield, no army charges without a signal. Trumpets, drums, a flag raised high, something clear that says, now attack. In trading, that signal is just as vital. Without it, you're firing into the fog, wasting ammunition, exposing yourself to traps. With it, you strike at the precise moment the odds tilt in your favor. Every great trade rests on recognizing the three-phase signal. Phase 1 is weakness. The enemy falters, their attacks slowing, candles leaving long wicks, momentum fading. You see their strength draining, and you know the shift is near. Phase 2 is the standoff. Neither side advances, neither retreats. On the chart, it's a cluster of small-bodied candles, tight ranges, the eerie silence before the storm. To the untrained eye, it looks like nothing, but to the disciplined trader, it is a pause heavy with tension. Phase 3 is the breakthrough. A decisive candle slicing through the hesitation zone, bold, undeniable, the roar of victory. That is the trumpet blast, the moment to strike. The danger lies in impatience. Rookies mistake weakness for reversal and fire too soon. Others get stuck in the standoff, chopped to pieces. The wise wait for all three, knowing that discipline filters noise into clarity. This pattern repeats everywhere. Bitcoin's pullback, Tesla's fake breakout, the S&P breaking free of summer chop. Weakness, standoff, breakthrough. 3 phases, 1 story. When you master it, you stop gambling and start commanding, firing only when the signal is clear, undeniable, and aligned with strength. On a battlefield, nothing is more dangerous than a soldier who fires before the order. His musket flashes, alerting the enemy, spreading panic through his own ranks, and suddenly the formation collapses. In trading, impatience works the same way. Pull the trigger too early and you step into your own ambush. At every fortress level, support or resistance, 3 outcomes exist: Price can reverse cleanly. It can fake the reversal, then whipsaw back, or it can plow straight through as if the walls never existed. 2 out of 3 of those outcomes crush early entries. Traders who act without confirmation gamble against the odds. Remember Tesla at $400? Those who jumped before the signal were obliterated. Assumption replaced evidence, and hope replaced discipline. Impatience doesn't just cost money, it corrodes the mind. Each premature loss plants doubt, making you hesitant on the next trade, or reckless as you chase to recover. One bad entry snowballs into emotional warfare that can undo weeks of progress. Patience, by contrast, is armor. It shields you from wasted battles. It doesn't guarantee every win, but it ensures you only fight when the field tilts in your favor. The paradox is simple. By trading less, you profit more. By waiting, you keep your army intact for the campaigns that matter. The battlefield rewards discipline, and those who fire too soon are buried beneath the dust of their own haste. A battle isn't won the moment you charge. Victory comes from knowing how to advance, when to retreat, and how to protect your forces in the chaos that follows. Trading is no different. Entering a position is only half the fight. The other half is trade management. A wise general sets objectives: capture the hill, secure the bridge, hold the line. In trading, those objectives are profit targets, measured in multiples of risk: 2R, 3R, sometimes more. They aren't fantasies, they are milestones that tell you when to secure ground before overextending. And just as armies retreat to preserve strength, traders use stop losses as strategic withdrawals. Place your stop just beyond the fortress walls. If breached, the defense failed, and it's time to pull back with dignity rather than be destroyed. Sometimes, after progress, you move your stop forward, trailing like supply lines shifting up, locking in captured territory while leaving room to advance. But balance is vital. Move too fast and you strangle your troops. Move too slow and you risk losing hard-earned ground. Overconfidence is another enemy. After one clean win, many double down recklessly, believing they're invincible. Yet generals know every victory could be followed by an ambush. Discipline means respecting risk, keeping leverage in check, and remembering no single battle defines the war. Trade management is quiet work, not glamorous, but it is what keeps armies alive. The traders who master it don't just win trades, they survive campaigns. Every general knows there are battles not worth the blood. Skirmishes fought on treacherous ground, traps designed to lure the overconfident, fights that drain resources with nothing to gain. In trading, these are the setups you must learn to avoid: chaotic sideways markets, half-formed signals, or zones already breached and weakened. They are slaughterhouses, not opportunities. Look at the meme stock frenzy of 2024. AMC, GME, and their cousins turned charts into circus arenas. One day they soared on hype, the next they collapsed just as fast. Rookies charged in, believing they could outpace the madness, only to be shred by whipsaws and liquidity hunts. What seemed like opportunity was actually quicksand. The trap lies in thinking you must always trade. Many believe sitting still is falling behind, but the truth is the opposite. Every unnecessary entry erodes capital and weakens the mind. By the time the real opportunity arrives, you are too wounded to seize it. Skipping trades feels passive, but it is an act of discipline. Each avoided ambush preserves money and clarity. Think back to the S&P's choppy summer of 2024. Countless accounts were wrecked as traders guessed direction on every fake move, while the disciplined waited until the fog cleared. The difference wasn't intelligence, it was restraint. Survival in trading comes not from endless fighting, but from choosing battles with precision. Avoiding the wrong fights is as vital as winning the right ones. Once you accept that truth, you shift from casualty to commander. Every war has its heroes, but they are rarely the ones who charge recklessly into gunfire. True heroes are the ones who endure, who fight with discipline long after others have fallen. In trading, the disciplined warrior is that hero. He doesn't win because he knows every indicator or follows every hype headline. He wins because he masters himself. Look at the traders who survive years, even decades. They all share one trait: patience backed by discipline. They treat trading as a campaign, not a single battle. Losses are not shameful. They are the price of doing business, as long as they are controlled. Boredom is not failure. It is part of the process, waiting for the right strike. The disciplined warrior waits for the fortress, waits for the signal, waits for the field to tilt in his favor. Backtesting becomes his training ground, risk management his supply line, patience his shield. He learns to see boredom as preparation, not punishment, and restraint as strength, not weakness. This mindset transforms him from a casualty into a commander. Mastery in trading isn't about predicting markets, it's about controlling yourself. The market is a storm, violent and unpredictable, but your discipline is the anchor that keeps you steady. That is why discipline is the greatest edge. It outlasts speed, outlasts adrenaline, and outlasts luck. The disciplined warrior may not win every battle, but he endures every campaign, standing tall when others are gone, his scars proof not of recklessness, but of resilience. If you've made it this far, you know this isn't just a story about trading, it's a story about you. You've walked through the battlefield, seen the ambushes that destroy rookies, stood in the fortresses that protect profits, and felt both the sting of false breakouts and the triumph of disciplined entries. You've heard the call to transform from a gambler chasing noise into a warrior who survives, adapts, and wins. Now the choice is yours. Don't let this just be another video you watch and forget. Take one lesson, just one, and put it into action today. Maybe it's marking out the 4 terrains on your chart. Maybe it's refusing to trade in chaotic chop. Maybe it's waiting for the 3-phase signal before pulling the trigger. Whatever it is, let it harden into discipline, because discipline is built not by thinking, but by doing. Tonight, when the futures open, or tomorrow when the bell rings, you face a decision. Enter the battlefield as the same trader who began this journey, or step forward as someone who sees with clarity. Open your charts right now, mark one fortress, and watch how price respects or breaks it. That single act begins your transformation, and you are not alone. Thousands of us are walking the same path, learning the same lessons, fighting the same inner battles. Together, we form an army of disciplined warriors. So subscribe, join this campaign, and share your scars. Comment below, what's the one battle you keep losing? Overtrading? Chasing breakouts? Cutting winners too early? Name it, because once you name the enemy, you can defeat it. Add the word warrior if you're ready to commit. Share this with someone who keeps getting wrecked. You might save them from their next ambush. The war never ends. The market opens again tomorrow. But every day you step forward with more patience, more clarity, more discipline, you carve yourself into the trader who not only survives, but thrives. Your edge is not an indicator. It's you. The next battle is coming. Will you face it as a casualty or as the warrior you were meant to be?